Most retirees lose thousands before their first pension check arrives. Not a little, tens of thousands, gone before day one. The retirement date is not emotional. It is a financial decision. Wrong month, wrong tax bracket, thousands gone permanently. Two retirees, same savings, one calendar choice, completely different outcomes. The difference? One calendar variable. Nothing else changed. Your federal tax bracket resets to 0 every January 1st. Income stops. But the IRS calendar doesn't stop with it. Retire in December? You paid full-year taxes all 12 months. Retire in January? Your taxable income starts near 0. A near-zero income year is a wealth-building year in disguise. Roth conversions and tax gain harvesting both unlock in that window. Most retirees never see that window. They retire in December. Over 60% of workers retire in the final quarter annually. That single timing mistake costs the average retiree real money. Nobody at HR tells you this. Check your own numbers. Retirement planning is sold as savings strategy. It is actually tax engineering. The best retirement move isn't a fund, it's a date. Pension, bonus, PTO, all sitting on that calendar, untouched. 30 years of building wealth. The exit strategy matters most. Spring retirees report higher well-being scores. That data is real. Northern climates, winter retirement, cabin fever costs money too. Well-being is a budget line. Plan for it deliberately. The system doesn't care about your feelings. Learn the rules first. One right calendar choice outweighs 10 years of fund selection. Medicare Part B has an enrollment window. Miss it. Pay forever. 10% penalty per year, permanently. For missing one window, healthcare and retirement is your largest unpredictable expense category. Schedule that procedure before your last day. Insurance is still active. Most people plan the party. They forget the coverage gap entirely. The gap between retirement and Medicare eligibility is dangerous territory. Bridge coverage costs far more than most retirees budget for it. Your employer bonus often hits in Q1. Leave early and lose it. Accrued PTO is cash. It pays out at your current salary rate. 4 weeks PTO at peak salary is 4 weeks of real income. Pension systems credit benefits based on your final completed pay period. One extra pay period can permanently raise your monthly pension amount. Permanently higher. Every month. For the rest of your life. Social Security timing is its own separate optimization problem entirely. The calendar is not paperwork. It is your final financial lever. January, retirement. Near zero income. Maximum financial flexibility unlocked. Spring retirement adds outdoor days. Well-being is a wealth variable. Tax, health, pension, mood, every variable has an optimal month. That optimal intersection exists. Most retirees walk right past it. The actual math behind this, that is what changes everything next. Federal tax brackets reset to 0 every January 1st. Use that reset deliberately. Retire January 2nd. Your taxable income for the year is near 0. That near 0 income year is the Roth conversion window you need. Roth conversions at 12% versus 22%. That difference is real money. On a $50,000 conversion, that gap saves you $5,000. $5,000 saved now, invested at 7%, grows to $40,000 later. Your income is not your wealth. Your after-tax savings rate is your wealth. Tax gain harvesting. Sell appreciated assets at 0% capital gains tax rate. Single filers owe 0% on gains up to $47,000 in 2024. Sell your VU position at a gain. Pay nothing. Rebuy immediately after. Reset your cost basis. Pay no tax. This is legal and massively underused. This only works in a low-income year, exactly what your retirement year is. Layer the Roth conversion on top of the harvest. Double advantage, same calendar year. The best account is not the one with the highest return. It is the one you optimize. Pension timing. Most systems credit full benefit only for completed whole month service. Retire on the last day of the month, Capture full pension credit, not partial. Retire one day early and lose that full month of pension credit permanently. In many pension systems, one extra month means $60+ monthly forever. $60 monthly over 20 years equals $14,400 total. $14,400 gained for one extra day of employment. Annual bonus timing. Know your employer's exact payment cycle before you resign. Most bonuses require employment on payment date, not on performance year end. Leave before the payment date and you forfeit the entire bonus amount. A $10,000 bonus completely changes your optimal retirement date calculation. Accrued PTO payout, up to 4 weeks of final salary paid as a lump sum. At peak salary, that PTO lump sum may be the largest single paycheck you ever receive. Warning, that PTO lump sum is fully taxable income in the year you receive it. If it lands in a low-income retirement year, the tax impact stays minimal. Stack it wrong, and you push into a higher bracket unnecessarily. Timing controls everything. Diversification is not about owning more, it is about owning less of the wrong things. Medicare eligibility begins at 65, completely independent of your retirement date. Retire at 62, and you face a 3-year healthcare gap to fund independently. COBRA continues your employer plan up to 18 months at full premium cost. Healthcare marketplace plans are the alternative, and your income determines your subsidy. The data is clear. But there is one piece most retirees still get completely wrong. Think of your retirement date as a boulder positioned at the top of a hill. Push it at the wrong angle, and the trajectory is off permanently and compoundingly. That boulder represents your tax position, pension credit, and healthcare gap combined. Angle it correctly, and the momentum builds for you, not against you, for decades. Real data. Average bridge healthcare costs between retirement and Medicare run $12,000 annually. A low retirement year income keeps you inside the ACA subsidy eligibility zone. Exceed 400% of the federal poverty level, and your subsidy disappears completely. Controlling retirement year income is not passive. It requires deliberate, proactive decisions. Defer Social Security, pull from Roth. Stay deliberately under the subsidy income cliff. Roth withdrawals are tax-free and do not count toward ACA-modified adjusted gross income. This is why building Roth assets before retirement is structural, not optional. Vanguard data, average Roth IRA balance for savers over 60 is around $90,000. That average is low because most people started late and contributed inconsistently. Max your Roth every year, $7,000 under 50, $8,000 at 50 plus. $7,000 per year from 45 grows to nearly $200,000 by 65. Tax-free growth, no RMDs, no ACA impact. The Roth is structurally superior in retirement. Now the Social Security layer. Timing this wrong costs more than most people realize. Claim Social Security at 62, and you receive 70% of full benefit permanently. Wait until 70 and collect 124% of your full benefit. The break-even point between early and late claiming is approximately age 80. Family longevity history tips the scale toward delay. No family history, recalculate. SSA data. Average life expectancy at 65 is now 84 for women, 81 for men. Delay Social Security while executing Roth conversions. The two strategies amplify each other. Live on Roth and taxable accounts from 62 to 70. Let Social Security grow. Social Security delayed credits grow at 8% annually guaranteed by the U.S. government. No ETF offers that. Not VOO, not VTI, not SCHD. 8% risk-free. Think about it. Required minimum distributions begin at 73 under current IRS rules. Large traditional IRA balances generate large RMDs, which generate large taxable income. Convert to Roth before 73. Use the low-income years. Shrink the RMD liability. You now have the complete system. The only question is whether you will actually use it. The boulder is at the top of the hill. You control the angle. The momentum does the rest for decades. Here is the complete 5-decision retirement month optimization checklist, one timeline to rule them all. Decision 1. Target January or February retirement to maximize your low-income tax year window. Exception: if your employer pays the annual bonus in Q1, retire the day after the bonus clears. Decision 2. Retire on the last day of a full month to capture complete pension service credit. Retiring one day before month end loses a full pension service month, a permanent, irrecoverable loss. Decision 3. Schedule all deferred medical and dental procedures before your last day of employer coverage. Dental, vision, prescription coverage all reset when you leave. Use every benefit before your final day. Annual dental work alone can run $1,500 to $3,000 without employer coverage. Decision 4. Map your complete healthcare bridge strategy before you submit the resignation letter. If retiring before 65, use COBRA for up to 18 months, then Marketplace until Medicare activates. Keep income below the ACA subsidy cliff. That discipline alone saves $4,000 to $6,000 per year. $4,000 to $6,000 per year over 3 bridge years equals $12,000 to $18,000 saved. Decision 5. Execute your Roth conversion strategy in year 1 of retirement, not in year 5. Convert exactly to the top of your current tax bracket, not $1 over, not under. Bracket filling is the most tax-efficient move available to a retiree in a low-income year. Layer tax gain harvesting in the same year, 0% on long-term gains inside that bracket. You are now paying the lowest rate on money that will compound tax-free for the rest of your life. Let's run the full case study. Retiree at 62, $500,000 in total savings. Portfolio split: $300,000 traditional IRA, $150,000 Roth, $50,000 taxable brokerage. Retires January 2nd. Year 1 income: $40,000 drawn from the traditional IRA only. That $40,000 leaves room to convert $30,000 more from traditional to Roth at 12%. Tax on the $30,000 conversion: $3,600, a fraction of peak earnings cost. Simultaneously harvest $30,000 in gains from the taxable account at 0% capital gains tax. In year 1 alone, this retiree saves over $7,000 in taxes legally, permanently, and simply. Repeat this for 8 years, ages 62 to 70, and cumulative tax savings exceed $50,000. At 70, Social Security activates at the maximum delayed rate 124% of full benefit. Traditional IRA is now significantly smaller. RMDs at 73 are manageable, not a tax bomb. Roth balance has grown tax-free from $150,000 to over $300,000 by age 70. The boulder is rolling. The trajectory was set on January 2nd. Everything compounds from that single decision. This is not aggressive tax planning. It is basic tax awareness that most retirees simply never learned. The Federal Reserve reports over 25% of Americans have zero retirement savings. If you are watching this, you are already ahead of 1 in 4 Americans. Now, use that advantage deliberately. BLS data: median American worker retires with less than $100,000 in total savings. You do not need to be rich to optimize your retirement month. You need a checklist and a calendar. Every year you delay starting Roth contributions costs compounding tax-free growth you will never recover. VOO tracks the S&P 500. Historical average annual return, approximately 10% over 50 years. $1,000 per month in VOO from age 40 grows to approximately $1.2 million by 65. But the month you retire determines exactly how much of that $1.2 million you actually keep after tax. Stealth wealth principle: it is never what you earn, it is always what you keep after every single tax. The January retiree with a plan keeps $50,000 more than the December retiree without one. Same portfolio, same career, same fund, completely different outcome. The difference is information and timing. Write down your target